Welcome to this TalkTickers Deep Dive. We take the latest earnings calls and, well, really try to pull out the signal from all the noise for you. Today, it's BEEM Global's first quarter 2025 results on the table. We've gone through the earnings call and we're ready to unpack the key financials, management's take on things, and what they see coming down the pike.
Yeah, this was definitely an interesting one. A bit complex, you could say. Some challenging headline numbers for sure, but also some clear strategic moves and a fairly strong narrative from management about the direction they're heading.
Absolutely. So let's start with that snapshot. Q1 2025 revenues, $6.3 million.
Right.
And as management noted, that's roughly half compared to the same time last year. The GAAP net loss reported was $15.5 million. So those numbers, they definitely grab your attention right away.
They do. And management, they spent a good bit of time putting context around those figures, explain what was really driving them.
Okay, so let's dive into those raw numbers properly. Revenue, $6.3 million, down significantly year over year, as we said. But the gross profit picture is a bit different, isn't it?
It is. So GAAP gross profit was $500,000, about an 8% margin. But, and this is key, that number includes $1 million non-cash hit from depreciation and amortization linked to their acquisitions.
Ah, okay. So accounting stuff, not necessarily operational cash profit.
Exactly. And if you look at the non-GAAP gross margin, which pulls out that non-cash D&A, well, that was 21% for Q1 this year.
21%. Wow, that's quite a jump from last year.
It is. Q1 2024 non-GAAP was 12%. So even though they sold less stuff, the profitability per unit on a non-GAAP basis actually improved quite a bit. Management basically said this shows the integration of the acquisitions is working, leading to better margins.
Right. So underlying efficiency is improving even with lower sales. Okay, moving down the P&L. The operating expenses. GAAP number looks huge, $16 million.
Yeah, another eye popper. But just like the gross profit, there's a massive non-cash element distorting that GAAP figure.
Let me guess, the Goodwill impairment.
You got it. A $10.8 million Goodwill impairment charge is baked into that $16 million. So if you strip out all the non-cash items, the impairment, the D&A, stock-based compensation, credit loss provisions, then the non-GAAP operating expenses land at $4.1 million for Q1 2025.
And how does that compare to last year?
Pretty stable, actually. It was $3.8 million in Q1 2024. So the actual cash-based operational spending didn't increase dramatically year over year, despite the scary GAAP number.
So that $10.8 million impairment really explains most of that big GAAP net loss of $15.5 million then.
Absolutely. They pointed out that $12.5 million of the total GAAP net loss was from non-cash items, with the impairment being the biggest piece by far.
Okay, so the non-GAAP net loss gives us a clearer operational picture.
Yeah, I think so for this quarter. It came in at $2.8 million loss for Q1 2025 compared to a $2.1 million loss in Q1 2024. So operationally, the loss did widen a bit year over year on that non-GAAP basis, but nowhere near the $15.5 million GAAP figure.
Got it. Now, what about cash? The balance sheet showed cash decreased, right? Down to $2.5 million at the end of March from $4.6 million at the end of December?
It did decrease, yes. But interestingly, management made a point of highlighting that the cash used for operating activities actually improved.
Oh, how so?
They used $1.8 million in cash for operations in Q1 2025, whereas they used $3 million in Q1 2024. So less cash burn from day-to-day operations this quarter. They also emphasized having no debt and feeling they have enough cash and working capital.
And finally, backlog. Where did that stand?
$6.3 million at the end of Q1.
Okay. Roughly equal to the quarter's revenue. Shows some near-term visibility, I suppose.
Yeah, a baseline level of business already booked.
Okay, let's really unpack that Goodwill impairment. $10.8 million is a huge number. What exactly triggered that? Was it something specific to the acquisitions?
Right, it's crucial context. It wasn't about the acquired businesses suddenly failing, according to management. It was purely an accounting requirement under GAAP.
An accounting requirement.
Yeah. What happened was the company's market cap, the total value of its stock, fell below the value of its net assets on the books at the quarter's end. This happened because the stock price had gone down since the end of last year.
Okay. So market fluctuation triggered it.
Exactly. When market cap drops below net asset value, GAAP rules basically force a company to check if the goodwill on its balance sheet is impaired. And if so, write it down.
And goodwill is that intangible value paid over book value during acquisitions, right? Like brand synergies, that sort of thing.
Precisely. It's an accounting plug for the premium paid. So the market valued the whole company less than its book value, forcing the accounting write-down of that intangible goodwill.
So management's view wasn't that the acquisitions themselves lost value.
No, quite the opposite. They were pretty clear, even forceful, saying this impairment is not an indicator of poor performance past, present, or future from those acquired businesses. They actually argued the acquisitions and the goodwill are more valuable today because they're key to their global expansion and growth strategy.
So they see it as a disconnect between the accounting rule triggered by stock price and the actual underlying business value.
That's exactly the message. They said it's non-cash, has no impact on the operational viability or its true value, in their opinion. And apparently navigating this complex accounting with the auditors was why the earnings call notice came out a bit late.
Okay, that definitely helps frame that big loss number. It wasn't operational collapse, but an accounting adjustment driven by market cap. Let's pivot then to the revenue side. That year-over-year decline, what drove that?
The main reason cited was uncertainty around the U.S. government's zero-emission vehicle strategy, especially with the election coming up. Specifically, the GSA, government's purchasing arm, apparently paused acquisitions of EVs and charging infrastructure.
And that federal business was significant for them before.
Yeah, it was a major chunk of revenue back in Q1 2024. So that pause really hurt the top line this quarter.
Ouch. So how are they responding?
Well, management framed it as basically accelerating a strategic shift. They were already working on diversification. And the numbers show they've actually made some serious progress there.
Diversification how? Like different customers?
Exactly. Enterprise and commercial customers made up 53% of their revenue in Q1 2025. Compare that to just 16% in Q1 2024. That's a huge swing in just 1 year.
Wow. Yeah, that's a massive rebalancing. What about geographically?
International growth is becoming much more significant, too. International revenue hit 25% of the total this quarter, up from 11% last year. And that's even with Q1 being typically slow for their European side, with contributions noted from places like Croatia, Serbia, Romania, and Spain.
So they're finding traction outside the U.S. federal government?
Definitely. They reported 41% year-over-year growth in sales to non-government customers overall. So while the federal piece slowed dramatically, other segments picked up the slack and actually grew quite a bit.
And state and local governments, are they still buying?
Yeah, they mentioned that segment remains important. California is still a key state, and they see potential with municipal customers, too. They shipped product across multiple U.S. states and internationally in Q1, demonstrating that broader base.
Okay, so the revenue recognized was down, but what about new business coming in?
That's another interesting point they made. Sales orders they received in Q1 were actually up 23% compared to Q4 of last year. And importantly, that was without any significant federal orders.
So demand from these other segments is picking up, it just hasn't all hit the revenue line yet.
Pretty much. Orders take time to build, ship, and then get recognized as revenue. So the order book growth suggests underlying momentum in those non-federal areas.
And how are they reaching these new customers? Is the sales strategy changing?
It seems so. They're putting more emphasis on using outside resellers and distributors, not just relying on their direct sales force. They've got someone managing resellers in Europe and a VP in the US focused on recruiting and training them.
Any examples of how that's working?
Yeah, they mentioned their EV ARC product got prominent display space at a big international defense exhibition in Europe through a partner called EFI, and it's going to be at the Valencia Grand Prix circuit soon, again via partners. This gives them visibility without having to build out their own huge operational presence everywhere.
Makes sense. So beyond the main EV ARC, are other products contributing? They've made acquisitions over the years.
They did touch on that. Growth in things like the ARC mobility trailers, energy storage systems, even lighting poles and smart city infrastructure from their legacy European business orders are apparently growing there too.
And they sounded quite excited about some new variations on the EV ARC platform itself.
Yeah, definitely some enthusiasm for BEEM Patrol, that's for police motorcycles, and charging BEEM Bike for e-bikes, and BEEM Spot for curbside charging. The idea is these leverage the core EV ARC platform, potentially boosting overall production volume and maybe improving the unit economics for everyone.
What about the battery business they acquired back in 2022? Is that finding its niche?
It sounds like it's becoming quite specialized. They're focusing on high-performance, safety-critical applications. Think defense, power sports, micromobility, marine defense, like underwater stuff, and drones, certain commercial uses, industrial robots.
So not just standard EV batteries.
No, definitely more high-end. They highlighted their proprietary tech phase change composite, or PCC, paired with active cooling. Apparently, this PCC is really good at managing battery temperature, which is vital for performance and lifespan in demanding situations. They describe these as technical, custom, and higher margin solutions.
Interesting. They also mentioned a significant focus on the Middle East and Africa.
Yes, a big strategic push there. The CEO talked about upcoming travel to Jordan. They're demonstrating a new product called BEEM to the Jordanian Armed Forces.
BEEM, what's that?
It sounds like a self-contained unit for crisis zones. It can apparently convert salt water to fresh water, generate electricity, and provide mobility using ruggedized scooters. The potential use case discussed was aid delivery in Gaza, crucially without relying on damaged infrastructure. And he made a point of saying they intend to sell it, not just donate it.
Wow, okay. That sounds impactful. Any other Middle East plans?
Yeah. Also traveled to the UAE. They're looking for opportunities in huge projects like Master City and NEO-M, these massive futuristic city developments focused on sustainability.
Yeah.
Big potential sales if they can land contracts there.
This actually ties into another big theme they kept hitting on. Resiliency.
That was a core message. They're positioning themselves not just as EV charging, but as providing power and charging off-grid without construction and, crucially, working during blackouts or disasters.
How did they back that up?
They threw out some specs flood-proof, up to 9.5 feet, survived 185 mile-per-hour Category 5 hurricane winds, and they gave a specific example. Units operating just fine, sitting in 8 feet of storm surge during Hurricane Helen. That really paints a picture of grid independence under extreme stress.
And their customer list seems to reflect that focus too, doesn't it?
It does. You've got the U.S. Army, New York City, the Marine Corps, and notably the California Office of Emergency Services, OES. Their single largest order ever actually came from OES, which is all about disaster preparedness.
And that BEEM product you mentioned sounds like the ultimate example of that resiliency idea.
Exactly. Providing water, power, mobility in places like Gaza or post-Hurricane Florida where the normal infrastructure is gone or unreliable, it directly addresses those fundamental needs in a crisis off-grid.
They also touched on the political angle, didn't they? Positioning for different administrations.
They did, neutrally reporting it. They mentioned an effort to frame their products for a potential future Trump administration, not just as environmental tools, but as disaster preparedness tools that enhance American energy security. It shows they're trying to appeal across different priorities.
And that resiliency message travels.
Apparently so. They even mentioned finding resonance in the UAE, talking about flood-proofing after Dubai and Abu Dhabi had those unexpected severe floods recently. It's a capability that seems relevant in more places than you might initially think.
Okay, so wrapping up, let's look at the outlook. Management didn't sugarcoat the recent performance, did they?
No, they acknowledged Q4 last year and Q1 this year were rough and rocky. Called the results disappointing, but also said not surprising given that specific federal government situation they faced.
But they sounded confident about the future.
Very much so. The message was, essentially, we have the pieces in place now. They believe the diversification, customer, product, geography, and the improved underlying margins set them up to return to growth starting in Q2 and beyond. They expressed confidence in getting towards positive cash flow.
So they see the tough period as maybe necessary to build this more resilient, diversified foundation.
That seems to be the narrative, that the work done over the last couple of years, what may be painful recently with the federal pause, has created a stronger base and opened up opportunities that are potentially much bigger than what they relied on before.
And despite the broader market being tough for, green tech and electrification stocks.
Right. Despite those headwinds, they said the team is just focused on execution, shipping product, driving sales in the areas they can control, and really leaning into that resiliency angle.
So key strengths they'd point to are growing orders in non-federal markets, the belief growth is coming back, no debt, what they see as sufficient cash, plus these big potential upsides from new products like BEEM and the international push, especially the Middle East.
Yeah, it feels like they're signaling, look past the temporary federal hit and the accounting noise. The core strategy is shifting, diversifying, and focusing on high-value, resilient solutions, and that's where the future growth lies.
Okay. And now, as always, time for something a bit different to chew on. Our This Is Not Financial Advices segment, where we float an outrageous but plausible trade idea based purely on what we heard in the call.
All right, let's play with this purely based on the transcript. So management gets hit with this huge $10.8 million non-cash Goodwill impairment. Why? Because the stock price dropped, pushing market cap below net assets. Standard accounting procedure.
Right.
But then management explicitly says, hold on, we think those acquired assets and the goodwill are actually more valuable now. They're key to our global growth. So you have this direct conflict, accounting write-down, versus management's stated belief in increased underlying value.
And at the same time, they're highlighting potentially significant new growth avenues international, especially Middle East, Africa, with things like BEEM, these specialized batteries, the other new products.
Exactly. So putting just those pieces together from the call, the outrageous but plausible trade idea could be a speculative long position.
Betting that the market gets it wrong.
Essentially, yeah. Betting that the current market price, potentially weighed down by the federal slowdown noise and maybe spooked by the non-cash impairment figure without fully grasping management's counter-narrative, doesn't reflect the underlying value or the growth potential management sees.
So the thesis would be, the market eventually catches up, recognizes the diversification, sees traction internationally or with new products like BEEM and critical roles, and realizes the value from those acquisitions is there, maybe even more than before, leading to a re-rating closer to management's view.
That would be the core idea, that these new growth drivers, international specialized products, resiliency applications, eventually become significant enough to overshadow the past reliance on federal spending, forcing a reappraisal of the company's value.
Okay, interesting thought experiment. But we have to stress.
Absolutely. This is purely connecting dots within the earnings call narrative we just discussed. It is definitely not investment advice. Do your own homework, your own research before making any decisions. This is just mental exercise.
Couldn't agree more. So, to recap, we looked at BEEM Global's Q1 financials, really digging into those big non-cash items like the Goodwill impairment. We talked through management's explanation for the revenue dip and their strategic pivot towards diversification across customers and globally.
Covered the expanding product lines, especially the focus on specialized batteries and the new BEEM system, and that strong emphasis on the resiliency narrative, backed by some pretty compelling examples.
And finally, management's outlook, acknowledging recent challenges, but expressing strong confidence in a return to growth based on this diversification and new opportunities.
Yeah, it was a quarter where the headline GAAP numbers looked rough. But the underlying story from management was one of strategic execution, building a more diversified base, and targeting potentially high-value niche markets globally.
So the provocative thought to leave you with, what happens if they do land one of those major international projects they're chasing in the UAE or elsewhere? Or if BEEM really gains traction in humanitarian or defense circles? How could proving that real-world resiliency and critical application success change the story, maybe even faster than people expect?
It's definitely something to think about as you digest the information from this quarter's call.
Thanks for joining us for this deep dive into the BEEM Global Q1 2025 results. We hope these insights give you something to consider. Feel free to explore further on your own.